Hello, everybody. Welcome to this 1nvest webinar on the 24th of October. We're looking forward to spending the next couple of minutes with you, taking you through what has happened in the 1nvest ETF range. We've listed 3 new ETFs in the last 3 months. We're going to give you a bit of an overview of why we listed them, what they are, why would you think South African investors should care. We're also going to jump into looking at market cycles and which asset classes make sense. And then lastly, we're going to look a bit at the South African ETF landscape. Again, what has happened less over the last 3 years, but more over the last 20 years, and where we see the next couple of years plays out from a product perspective. Maybe just to set the scene around timing-wise, myself and Basdeo that joins me here today are going to do the conversation. We're going to split it up. So I'm going to hand over to him. He's going to hand over to me. In the middle of our presentation, we're probably going to take a quick pause to look if there are any questions on the chat box. So please post your questions if you've got any during the presentation. We're probably going to keep the presenting side down to 30-35 minutes to leave ample time to actually deal with your questions. We normally think is in the question sections is where it actually gets interesting. All right, so east to west. And I guess the theme is fitting because the products that we've listed covers global markets, they cover various asset classes, and they are from Asia to the US as well as a global product. So covering east to west in the global sphere. But let's firstly look at markets. I think it's no different to other times, i.e. quite a lot going on in markets. I think where we are now different to previous years, it's a lot more difficult. And the difficulty comes in a couple of dimensions. Firstly, there's no consensus around where different themes are in the market. And we've highlighted a couple of here, inflation, interest rates, geopolitical. There's no consensus around where they are. And even if you could call them right, and Ryan might touch on it later, we saw the CPI print out of the US last week as an example. The CPI print came in worse than expected. Equity markets went down quite aggressively in the 2 hours after the print and then recovered above the pre-announcement highs after the 2 hours. So even if you knew what inflation was going to do, the market calls was still going to be difficult. So I think the market is difficult because getting the call right firstly is difficult, and then predicting what markets will do is quite difficult. But let's look at quickly global themes that are playing out. Firstly, I think inflation is the big theme over the last 12 months. If we go back 12 months, the Fed was still calling it transitory. They've since moved to calling it slightly more sticky. And I guess the next question is it going to be structurally high inflation for a number of years? What does it mean? It means that central banks around the globe is hiking interest rates to try and curb inflation. So it's not only the US, it's happening in the UK, it's happening in the Eurozone, and it's happening in other developed markets as well. What does it mean for developing markets like South Africa? And that's why we're saying global macro is driving SA action and asset class moves. The SARB, even though our growth rate is not where developed market growth rates are, our employment rate's not there. We've got Eskom with load shedding. So even with all of that, they can't lose pace with global central banks. So we are hiking interest rates as well. The second theme is geopolitical remains high. Again, 12 months ago, it was probably a lot less. Since then, we've had Russia, Ukraine, that's still ongoing. Sometimes people forget because it doesn't grab the headlines anymore. But it's got a big component to play globally, but more so in Europe around energy. Them entering their winter, what does it mean for the inflation, cost of energy, cost of heating? We've got China that just went through another leadership congress and concerns out of them. We've got UK Prime Minister issues, not only last week, but I would guess the last 12 months. And then we're heading into a US midterm election. So all of that from a macro perspective, from a geopolitical perspective, very uncertain. And then the SA environment, as I mentioned, we've got our own things on the go, but mostly driven by global. Rand dollar being a big one. And then if we just look at our equity markets, a lot of dual listeds, a lot of foreign influences. And again, yesterday is case in point. We saw concerns out of China, which trickled through into Tencent, which meant that Naspers process was heavily down yesterday. I guess similar with our bond markets, foreign ownership in bond markets quite weak in South Africa. So if you see foreigners coming back in South Africa, that will drive our bond markets. A lot of people are calling for stronger bond markets, not based on SA fundamentals necessarily, but based on foreign flows. And then I guess for me, what is important from an investment point of view, or from an advisor point of view, is the change in the way asset classes are correlated. If we go back the last 20 years, you had equity and bond portfolios. They would offset each other in different market cycles, so they're uncorrelated. We've seen a lot more correlation in traditional asset markets, which means it becomes more difficult to talk about things like diversification. You can talk about diversification and saying, I'm going to pick more asset classes or more stocks, but are they really adding the benefit of diversification, which is to offset each other in different market cycles? And Ryan's going to touch on market cycles a bit later. So all of that, this makes for a very, very difficult cocktail in terms of markets. The one thing that ETFs do provide is they do provide you tools that wasn't previously there to give you access to markets. And Ryan's going to take you through the products that we've launched, and you'll see they are trying to fill gaps in the SA market that's there that previously you weren't able to isolate. So again, an example, if you go into global, traditionally 10 years ago, you would go into MSCI World because MSCI World is the only product available and it gives you broad market exposure. Since then, we've seen different products on the rise, and the one that we're going to show you today is an Asia-specific equity product that starts to fill a specific gap in the umbrella of MSCI World. But with that, I'm going to pass over to Ryan to take you through a bit of what we've done in the last 3 months.
Thanks, Wehmeyer, and hello everyone again. Apologies for this checkered shirt that might be a little bit hypnotizing on the other side of the camera. But yeah, as Wehmeyer mentioned, I'm just going to quickly touch at high level initially on the 3 new ETFs that we've launched over July, August, and September. And Wehmeyer also mentioned, our initial purpose or primary reason for choosing these ETFs is to fill gaps in that we saw in our product offering, our product range. And particularly gaps that we see that or provide diversification to some of our ETFs, as well as form important building blocks in a long-term asset allocation or long-term portfolio throughout a full economic or full market cycle. But maybe just to bring it back together into those to those ETFs. The first one that we listed this year in July, or to add to our current existing range, was the MSCI World Socially Responsible Investment Index, the ETF. So it is a mouthful, but we are guided by regulation on naming convention. And this ETF is, you probably would have heard of themes or thematics in the market, and ESG was one of them. We try not to pick, or we aim not to pick our new listings, our products on thematics. We prefer to look at products in a very systematic manner, and products that we see as structural asset classes or structurally form important parts of an overall portfolio. And therefore we landed, and we specifically chose this index in that ESG offering, because we think it's what we flagged as the heavyweight in this ESG space. A lot of ESG products out there tilt portfolios or tilt their holdings relative to a benchmark. Our ETF specifically excludes stocks. So it takes a very firm and strong view on ESG related matters. So for example, if a stock derives some of its exposure from adult entertainment, for example, our index specifically removes that stocks from its investable universe. And overall, just to give you an idea of the impact on that, the parent index, being the MSCI World, holds around 1,600 stocks. The holding in this index is brought down to just under 400. So it takes a very firm view on ethical and value-based investing. But I'll touch on this in a little bit more detail shortly. The second listing we did in October this year was the MSCI EM Asia Index. And again, this was to bring some geographical diversification in our product range, giving exposure to very vibrant emerging market countries, countries that are quite mature in the emerging market space. And I'll show you how that plays out a little bit later on in performance. And then lastly, what we've listed, and so I'll mention definitely not our last ETF, but probably the last one for this year is the US Treasury Index Feeder ETF. And ultimately, the aim or the idea behind this product was to provide investors with a proxy for a US dollar money market fund. So yeah, that's largely at a high level, the 3 ETFs that we've listed this year. And maybe if I just drill down into a little bit more detail on some of them, just to give you some additional flavor on each one. Firstly, starting with the SRI or ETFSRI is the JSE ticker for the responsible investment ETF. As you can see on screen, the sectors that this ETF aims to tilt the portfolio towards, or rather is an outcome of the entire investment methodology, largely puts its weights into your healthcare, financials, and information technology space or sectors. The ETF the index does aim to give you the same sector risk as the parent index, but tilting the individual stock holdings to the ethical value-based methodology. On the right-hand side of the slide, you can see the country exposure is again very closely matched to where the parent index is, the US being one of the largest exposures you'll get into this index. And then drilling down to some of the other smaller holdings, Japan, Canada, for example, Austria, Germany is not shown in the map, but that's all blocks under that, the small other, about 3 or 4% exposure, country exposure. And maybe again, just touching on the performance, I suppose, which has always been quite topical when it comes to ESG-related products, is yes, you take an ethical value-based view, but does that actually transpire or transform into long-term performance? So am I giving up performance for a value-based investment? If I know the chart on the top left is a bit small, but you probably can make out that over the long-term period, and this is just about 10 years, the index that our ETF aims to track does outperform the parent index, being the MSCI World. Looking bottom right to the table, if I look at the 10-year basis, the index, the SRI index outperforms the MSCI World by just over 1% on an annualized basis, so just over 1% annually. And maybe the last point I'd like to land on this slide is, even though the index does aim to take a similar or same risk as the parent index, if we look at the top 10 holdings, summing up the top 10 holdings of the index that we're tracking, summed up to around or just over 26%. If you compare those exact holdings in the parent index, those sum up to just under 9%. So again, just expressing the view that this index takes towards the stocks that derive its revenue based on ethical and a value-based metric.
Right. What's valuable here for me is sometimes if you go into the ESG space, there's probably 2 camps. There's a camp where you're saying, if I need to do it properly, I need to give up some return for doing good.
Yeah.
Or the other side is, I want an ESG product, but I'm happy not to lift the hood too far. So tell me you're doing something, but don't do too much because you're going to influence my performance. It's that greenwashing versus giving up performance. And what I like about this one is it actually brings the 2 together in saying, if you look at the active share here, this is taking active bets from a single stock perspective away from the index, excluding stocks, downweighting stocks completely. On the other side is it's still got a high correlation to the parent index. So if you look at that line chart, it moves together. Plus, it outperforms the parent index. So you're doing the real thing without giving up performance, which is, I guess, what all ESG investors in the global space would like to see.
And I like what you mentioned about the real thing, or because you currently see greenwashing being thrown around as well. You know, a lot of companies can do fancy accounting, for example, to increase their ESG scoring. That is coming to light now, coming to surface now. Whereas our index is not going to fall prey to that, because we would completely remove a stock out of the investable universe, not just down weights, for example. So if a stock has exposure to thermal coal mining, for example, it'll immediately remove the stock from the index, not just down weights. So not falling again prey to any fancy greenwashing that's out there at the moment. Cool. Okay, just I guess jumping on to the next ETF that we launched sometime in August. Again, a very important building block that we see in building an overall long-term portfolio, giving exposure to Asia, to the Asian stock market. On the right-hand side, if we start on that side, you can see this gives you exposure to, there's 9 countries in total, but just the largest ones are shown up here on screen. 41% to China, 19% to Taiwan. Some of the others that are not on the screen here is Malaysia, for example. And ultimately, these are very vibrant and very innovative countries. So a lot of the holdings you'd see, again, is tilted towards the information technology financial space. So your Taiwan Semiconductor, Samsung, Tencent being some of the top holdings in this. And if we think about long-term, where innovation generally starts to become technology, and this is where we see a lot of growth, especially if we look at the next chart here. Having a look at the graph there, you can see that Asian, or the specific index that we're tracking, the Emerging Markets Asia Index, has actually outperformed other emerging market countries. And this, again, is something that we looked at, particularly in making our decisions. Where do we think the growth space would be in emerging market countries? Where do we want to give particular exposure? So emerging market technology, for example, complementing some of the other products that we brought to market in terms of technology in the developed market space. And again, this is just a few of the decision points that we've made when introducing products into our offering, not just trying to be seen as a cookie cutter, for a lack of a better word, but something that would bring structural, meaningful value to a client's overall portfolio in the long term.
What I like about this one, Ryan, is if there's normally a crude distinction between developed markets and emerging markets, and you expect the developed markets to be slightly more mature, growing more steadily, but probably at a lower rate. And you've got emerging markets, which is slightly more volatile. They're still finding their feet. They're growing at a higher rate, but you're taking slightly more risk. So if I think about the countries that's in this ETFEMA index, they're probably on the more mature side of the emerging market scale. And you can see it by virtue of the sectors that they give you exposure to. As you rightly pointed out, they give you exposure to technology. And this is where a lot of the technology innovation is happening outside of the US. And if you subscribe to the notion that economic growth drives equity market performance long term, then this chart makes sense, where you see the black line of the Asian emerging markets outperforming overall emerging markets because they've grown at a higher pace than them over the last number of years. So the equity market has been able to outperform the general emerging market theme.
100%. And another nice key point on this ETF is the number of securities that you actually get exposure to. You can see up top right, it's just over 1,100 stocks that you get exposure to throughout Asia. So you're also not taking any very specific sector risk, even though you're getting coverage or geographical coverage, across Asia.
That's great.
Cool.
And then,
Kim, if I maybe pass back on to you to maybe touch on the last listing, which has been quite popular so far this year.
No, I think, Ryan, if we talk about popularity in the first couple of months, this is probably where most of our conversations have centered. And I guess it's not a surprise given what this product tries to do. Is ETFUSD gives South African investors exposure to US money market underlying bonds. So it's a US Treasury short bond index. You can see the effective duration on the index is 0.3 year, so not a lot of duration, so not a lot of interest rate risk when it comes to your capital. So what are you getting exposure to? You're basically getting exposure to US dollar ZAR. And what we did on the left-hand side is we charted the index compared to USD ZAR, and you can see the index, which is a proxy for our product, outperforms the currency by a small margin. And what is that small margin? That's basically the money market rate in the US. As we know, rates in the US have been low for quite a long time. So that effective interest rate, or the coupon, you see there the coupon is 0.43, 0.42. That's obviously going to increase with rates being higher, but you're essentially getting rand dollar exposure as a South African investor. Why should you care? I think a lot of people think about the currency from a personal portfolio perspective as one of the largest drivers of your overall portfolio outcome. If you think about post Reg 28 relaxation, so that is the regulation around how much SA investors within their retirement funds or pension fund can take offshore. That announcement came out in February, and it increased the limit from 30% to 45%. So effectively, you can take 45% of your money outside the country within a pension fund wrapper. And a lot of asset managers and solution providers don't want to do it because the currency adds quite a lot of volatility, but it remains an important call. Another benefit of this product is the ETF is classified as inward listed. So why should you care? As an individual, a corporate, and a trust, you can invest as much money in this without getting clearance from the Reserve Bank or from the tax authorities to take money out the country. So you can get rand dollar exposure without using any of your prudential or offshore limits. If you look at the return profile, it's less about what it's returned, and it's more to show you that the returns were similar to dollar rand. So we think this product is going to become heavily important in SA investors' portfolios. Another application that we've seen is a lot of people are saying they want to go long the dollar, but they actually don't like global equity markets. They don't like global bond or property markets. So where do they go if they only want dollar exposure? So this is a great way to think about your overall portfolio, adding just dollar exposure without having to latch on the equity or fixed income or property exposure.
Okay, man, and I guess another important point on this is, in most cases, treasuries are generally your risk-free reference rate.
Yeah.
And a lot of products out there that provide dollar exposure are generally in the ETN or exchange-traded note format, where you end up taking issuer risk. Whereas in this product, you're taking just US dollar treasury risk, US treasury risk.
Exactly. So in my mind, the most effective way to get this exposure without assuming other risks.
Yep.
Brian, I think before we jump to the next section, let's maybe go to the questions, see if there are any questions on the chat box first.
All right, guys. Sorry, I'm just going to turn away for a sec just to have a look at questions. Okay, Tandy, you've asked what is the fundamental difference between ESG and SRI. I mean, hopefully I've tried to express that throughout the topic there, or the preso on this ETF. But ultimately, the main difference is the methodology, and more specifically, the exclusion methodology in our parent index or investable universe. So ESG will apply certain factors or certain screening factors, and then underweight or overweight a portfolio relative to its parent index, whereas in our methodology, we completely remove the stock from the investable universe. So taking a more aggressive, a firmer stance on this ethical value-based investing.
But Ryan, I think that's an important question, because even if you just talk within ESG, there's no standardization around classifications or scoring. So you've got a lot of different ESG providers. They all have their own unique scores they apply to a share or a sector or stock. So one of the most difficult things is to distill between what's a good ESG process and a bad one, or maybe not good or bad, but which one aligns to your outlook of the world. How strict are they on certain industries, certain practices, and what's the subsequent consequence on that company around either being downweighted or completely excluded, as you say?
And the last one I'm seeing up on screen, Roger, is there you were asking, is there a lithium battery ETF you would look to recommend? Roger, I have to admit, it's not my area of expertise on the Tesla technology-based sort of ETF. But I can say that we're certainly working on a product that will give you exposure to that sort of technology, or to a company that employ, or companies that employ that sort of technology or derive their revenue from that sort of technology. But in short, nothing specific that's going to directly link you to lithium battery technology, for example.
Yeah, Roger, maybe just to add my 2 cents. I think in SA, from a granularity point of view, we're not there yet. And you can probably question, and we'll touch on it later when I talk about the landscape around, is the SA investor market big enough to bring that level of granularity to it? But definitely globally, if you look at the product range from the likes of iShares or Vanguard, you would actually go to that level of granularity, where as an investor, you can buy exposure to lithium battery producers or lithium battery value chain, so everything that's in that value chain. So globally, I'm sure on the New York Stock Exchange or London Stock Exchange, you will get an ETF that provides you that exposure. But in SA, as Ryan said, nothing yet.
Yeah, and I suppose something else that's important to that is, trying to keep costs low in product offerings versus giving a whole lot of exposure to a whole lot of granular investment. And the SA market, Wehmeyer will touch on later, is not in the mature phase as some of our developed world ETF markets. So we are very much about trying to balance costs and bring products to the market as cost effectively as possible, and not bring something that is not scalable and the costs end up eating into your investment performance. We are on the other side of that, trying to give exposure to long-term portfolio values as well as keep the costs as low as possible.
Ryan, anything else in the chat, or should we move on?
Yeah, I think we can move on, Wehmeyer. Yep, not seeing anything else. Cool.
All right, so Ryan's going to take you guys through a bit of economic cycle, how to think about asset classes, and then I'm going to jump into the SA landscape, and then we'll get back to questions and wrap up.
Cool, thanks, Wehmeyer. Okay, guys, so I won't go into detail into every little piece of the slide that you see on screen. I'm more going to give you a very high-level view. We can probably spend another hour going into the detail of every part of an economic cycle. But maybe just at a high-level view, what you see on screen is purely just a simple chart initially of what we see as a full economic cycle. And full economic cycle meaning from peak to trough, basically from a recovery phase of the cycle all the way to the peak of a cycle, and then back down to a recovery starting point. And markets do go through turning points or points of the market taking a different trend. I mean, if we think of the general academic definition of a recession, for example, it's around 20% of a market decline or market price decline from peak to trough. But largely, that is what an economic cycle refers to, is this movement of peak to trough. And then an important part of a fund manager or portfolio manager's job set or job skills should actually be being able to interpret the drivers of these cycles, and as well as where the future turning points are going to be. And as you've you've all probably been witness to this year, when there's a big disconnect between those drivers and the information that you would normally interpret in a certain manner to what actually spans out in markets. It becomes a very difficult environment to take these specific turning point views or to time the market, in summary, to time those turning points. But maybe if I just touch on two of those key turning points. So if we look at stage 2, for example, this is where the economy is bottoming out, for lack of a better word, or just coming off the late part of a recession. So you would expect to be in an environment where interest rates have declined or at a very low point. This generally helps bonds in pricing, so lower interest rates being applied to discounting the bond value, the higher the value of the bond, as well as you see low interest rates starting to be a very encouraging environment for companies, for corporates, to borrow money, to expand, to employ, and therefore you see stocks becoming very favorable at this very key turning point. So where policy has been very encouraging throughout the recession, you start to see the benefit of this turning point, of this low point now. And in that sort of key turning point, as I mentioned, you would likely want to be overweight stocks or long stocks and bonds in your portfolio, relative to some of the other laggers that you still see in part of this at this part of the cycle, such as your commodities. And then if I touch on another key turning point at stage 5 on your screen, this is where you've seen the cycle come through this very high growth phase. And as we've seen currently, where we've, or over these last 2 years, where there have been a lot of liquidity being pumped into the system, a lot of stimulus into the economy, you've got this massive growth phase, that big V-shaped recovery that we've seen. But that ultimately leads to high spending, high consumption or consumer spending, which ultimately leads to high inflation, which is a situation that we're currently sitting in, whether it be the property market, high wage demands that we've seen over the last 2 years. And what we've currently seen is that then the reserve banks try to counter that by increasing interest rates throughout or towards this mature part of the cycle. And then at that turning point, you start to see this impact of this high interest rates or this constraint being put into the economy. And ultimately, this is where you would have the opposite position to that initial recessionary, post-recessionary turning point of starting to downweight bonds, downweight stocks. Again, higher interest rates leads to lower bond prices, higher interest rates, higher borrowing costs in companies, corporates, which ultimately starts to, or the market starts to price in lower future earnings. And again, the key point, I guess, on the slide is that there's a lot of factors to consider when considering each stage of an economic cycle and trying to pick those turning points. And this year, or rather the last 18 months, we've seen all of those key factors, like Wehmeyer spoke about earlier, being hot topics: the inflation prints, Fed Reserve meetings, and the market trying to price in the future trajectory of interest rates. And that has been a very difficult time to try to anticipate or try to time the market. And it is, well, my personal view certainly that time the market is generally a difficult task. So we've again used this sort of interpretation of economic cycle in bringing products to the market, trying to make sure that we've got products that will complement an overall portfolio at various points or throughout this economic cycle. Wehmeyer, I don't know if you've got anything else to add to that, or largely happy.
Yeah, I think if I share your view, I think calling the cycle is difficult. An example is where we are now. So people are saying interest rates are being hiked. You're probably going to push the economy into a recession. So they're talking about soft landing versus hard landing. So there's again two camps. If it's going to happen, I guess most people are in the yes camp. When it's going to happen, Some people started expecting it in the corporate earnings cycle in the US. Now it's not transparent. So when is it going to happen? And then is it going to be a deep recession or a shallow recession? So all of that is quite difficult to call. Hence, adding diversifiers to your portfolio, like not only EM, but adding Asia EM as a specific. Not only taking global equity with dollar exposure, maybe taking some dollar exposure on its own. All of that just helps to build a diversified portfolio to sit through the cycle, which is very uncertain.
I mean, to your previous example about the CPI print last week, even if you knew what was going to happen, you would have been on the right side of the trade during the first half of the morning.
Yeah.
And 2 hours later, you would have lost money.
Exactly.
Even if you perfectly anticipated what that print was going to be.
Yeah. Agree. I see we are slightly running over our promised 30 to 35 minutes, so I'm going to quickly just, we just got a couple of products that's slotting in here, just showing which products we've got in which cycles, but this presentation will be shared with you afterwards, and then you can have a look at it in your own time. So maybe just looking, while our ETF offering is up here, maybe just talking about what's happened in South Africa. As you would all know, the ETF industry in South Africa is around 20, 21 years old. At the moment, there's 173 ETFs and ETNs, so exchange traded notes, listed on the JSE, and it makes up about 130 billion rands worth of market cap, which sounds like a lot, but if you compare that to the CISA, so CISA is the categories within the unit trust space, that's more than 3 trillion rand. So 130 billion plays 3 trillion. So it just shows you ETFs less than 5% of total unit trust savings in South Africa. So quite a lot of space for ETFs to grow by AUM. If I think about that 173 products being available in the market, it covers most of the important asset classes that you would want as an investor. And if you look at our product range, that's how we normally break it down. We look at equity, property, fixed income. Would be, if you look at any balance fund, would be the building blocks that you need. And we've got that locally and we've got that offshore. So in terms of a traditional balance fund portfolio, I think in SA, most investors have got their spoils. They can get their products from various providers and they can get it from 1nvest to build a fully balanced portfolio. So where does it leave us from a product development perspective? I think in the future, we're going to start seeing people filling some of the niche gaps. We got a question from Roger on lithium batteries. If people think lithium batteries is structural for the future, if we think there's enough equity to support that from an exposure point of view, and if there's a demand in South Africa, ETF providers like us are going to slot in product into this space, because it's not about what we think about it. It's about what the investor thinks about it, and does the investor want exposure to it. So I think globally, thematic exposure is going to become bigger in South Africa. Our definition of thematic, as Ryan pointed out, is probably different to some other people's definition of thematic. We think about thematic as structural thematic or trends, and even the trends is more structural. So we don't want to give exposure to something now that's going to bomb out in 2-3 years' time when the fad is over. It's more about saying what structural changes is happening in the global economy, what sectors or subsectors is going to benefit from that, and how do you isolate exposure to give clients exposure to it. So that's the first thing. I think the second thing is going to be where alternatives is going to enter the space, because if you look at globally, alternatives along with ESG is probably one of the hottest topics. The problem with that is, does it work for the average client? And what do you do with the illiquidity? Because if you look at alternatives, alternatives are different to traditional asset classes. Traditional asset classes, equity, property, fixed income, you can go and buy and sell them every day. So there's liquidity. Alternatives are not as liquid. Normally you are rewarded for that illiquidity. So if I'm willing to put my money in, wait for 10 years to get it back, I'm rewarded from a return perspective. But how do you bring that into an environment where ETFs trade daily? But I think alternatives is going to be a theme. And then lastly, I think solutions are going to become a bigger theme, Ryan. I think providers are going to start giving more solutions wrapped in an ETF to a client, and not only balance, but subsectors of a broader asset allocation. And I think actively managed ETFs might play a role in that. So I don't know if everybody has seen, but there's been new regulation out by the JSE and the FSCA around actively managed ETFs. And in my mind, when I heard it for the first time, it was a bit of an oxymoron. Where how can you have an actively managed ETF? Because in my mind, ETFs were all about tracking an index. But the ETF is basically just a listed unit trust. So can you take what's happening in the unit trust space at the moment, an active equity fund, and put that on exchange? So that's what an active managed ETF is trying to do. And I think that vehicle offers the possibility of providing index tracking ETFs into a solution.
And I think maybe an important point that you mentioned about the solutions-based mindset going forward is, even if alternatives do not become available in the very near future, for example, on the exchange, but blending an alternative investment with an ETF in a core satellite approach, for example, is something that you can still provide as a solution, and they complement each other. You use up your risk budget in your higher performing alpha asset, and the solutions can still be put together even if the products are not all available at one place, or it's not a one-stop shop rather.
No, I agree, Ryan. I think from our perspective, it's more on where client demand is going to go and trying to fill that client demand with appropriate product. All right. Thanks, everybody. That's towards the end of our presentation. We're going to stop sharing now. And Ryan, if you can maybe go to the
questions,
the chat to see if there's anything interesting on the go there for us.
We've had some great questions so far. So look again. Okay, we've got another question, Wehmeyer. Maybe you want to grab one. Right. Just hold a very holistic question around why would you invest in a global fund?
I think that's, for me, a very important question to be able to answer. And the reason why you want to invest in a global fund is because the SA market is quite small if you compare to global markets. And not only from an equity perspective, but also from a GDP contribution. So SA GDP contributes less than 1% of global GDP. So there's a lot of other global growth drivers that sits outside of South Africa. Secondly, our equity market is quite small in South Africa compared to the globe. So if I think about our all-share index, which is the biggest 160 shares, but even that tail is very illiquid. That compares to MSCI World, that's got developed market large cap shares at 1,600. And what do you get then? You get exposure to sectors that you would normally not get in South Africa. So you get exposure to information technology, which is not prevalent in South Africa. You probably get exposure to oil and gas if you want, because in SA, you can only get exposure to Sasol. You get exposure to different sectors. So why would you invest in a global fund? I think it is to diversify your local equity exposure, so to offer you something differently and broaden the drivers of return into your portfolio. And above the equity, it obviously offers you exposure to other currencies as well. So if you take a global fund, you're going to have some dollar-rand exposure, some euro-rand exposure, some UK-rand, some emerging market currency and rand exposure. So it just offers more dimensions to a local-only portfolio.
Cool, thanks, Wehmeyer. And just jumping to another question, someone asked around the specifics that, I guess, Xi Jinping's the election, whether we still think that ETFEMA is still a viable investment. I think in any specific ETF, there's going to be underlying specific holdings that would have very idiosyncratic moving parts to it, or specifics that would move the stock in certain directions. But ultimately, the ETF that we brought forward to the market, again, is something that is a diversified exposure, which you would use in a building block for a long-term portfolio, or constructing a long-term portfolio. So even though there are specific news that can move specific ETFs in a very short-term movement, which is going to be short-lived, we ultimately brought products. You heard this word get thrown around quite often, that would provide structural value in the long term. So even though it might seem like not a short-term trade, but I think from an investment point of view, it still would form a very important building block. I hope that answered you, Warren. Okay, Wehmeyer, I'm not seeing anything else up on chat. Let's have a quick look. I think I might have missed one. No, I think that's about it from the questions.
All right. So, Ryan, thank you very much for today.
Yeah, thanks, Wehmeyer. Thank you as well.
Thanks for joining us out there. If you've got any questions, please reach out to us directly, or you can just email to info@1nvest if you've got questions, and we'll happily send you a couple of answers or give you a call to take you through it. This webinar, as well as the content, will be distributed in the next week or so, and we look forward to chatting to you next time. Cheers.
Cheers. Bye, everyone.